In this video, we will explore about the Intelligent Investors Toolkit. We are going to look at the mechanics of valuation, how to measure asset performance, and crucially, the behavioral biases that affect our decisions. To start, we must understand that any valuation model is like a machine. Look at the diagram on the screen. It follows a simple rule called garbage in, garbage out. You pour inputs and assumptions into the funnel, such as the discounting rate, business risks, or growth projections. The model processes this and you get an output, which is the value of the company. The problem is that if your inputs are poor, your output will be unreliable. This is where sensitivity analysis comes in. It is a method where we change one variable at a time while keeping the others constant to see how much the final value changes. We also use scenario analysis to calculate values for the best case, the worst case, and the most likely case. This helps us understand if our valuation is fragile or robust. Because valuation involves so many assumptions, we need a safety net. This leads us to the concept of margin of safety. As you can see on the chart, the tall bar represents the intrinsic value or the true worth of the business. The shorter dark bar is the market price. The difference between these two is your margin of safety. This concept was popularized by Benjamin Graham and Warren Buffett. The definition is simple. You want to buy securities significantly below their intrinsic value. The purpose of this gap is to minimize your downside risk. It acts as a cushion against errors in your judgment or bad luck. Remember, there is no universal standard for this margin. Every investor must decide their own comfort level. Now, let us compare the two main asset classes, bonds and equity. On the left, we have bonds. The nature of a bond return comes from coupon income and potential gains if interest rates drop. The risk profile is generally lower, with the primary worry being default risk. On the right, we have equity. Here, returns come from the appreciation in the share price plus dividends. The risk profile is higher because there is no assurance of returns. Warren Buffett suggests a simple decision rule. If the rate of return on stocks is greater than the rate of return on bonds, you should buy stocks. Conversely, if bonds offer a better return, you should buy bonds. However, simply looking at returns is not enough. We need to calculate risk-adjusted returns. We have three main tools for this. First is Jensen's alpha. This measures how much a portfolio beats the expected return based on its risk. The formula is the return on the portfolio minus the result of the risk-free rate plus beta multiplied by the market risk premium. A higher alpha is better. Second is the Sharpe Ratio. This is used for undiversified portfolios. It measures the risk premium earned per unit of total risk. The formula is the return minus the risk-free rate divided by the standard deviation. Third is the Treynor ratio. This is for diversified portfolios. It measures the excess return per unit of systematic risk. The formula is the return minus the risk-free rate divided by beta. Moving on to the mechanics of the market, we need to measure the liquidity of equity shares. Liquidity simply means the ease of buying and selling. We use two ratios to track this. The first is the stock turnover ratio. This is calculated as the number of shares traded divided by the number of outstanding free float shares. Free float refers to shares not held by the promoters. The second is the traded value turnover ratio. This is the traded value of shares divided by the market capitalization. Both of these tell us if there are enough participants in the market to allow you to exit your investment easily. Now, let us shift gears from mathematics to psychology. We are going to look at basic behavioral biases. Conventional theory assumes that investors are rational wealth maximizers. operating like computers. However, behavioral finance recognizes that humans are emotional, irrational, and psychological. As Benjamin Graham famously said, markets are more psychological and less logical. We all have inbuilt biases. The goal is not to be perfect, but to build a defense mechanism against these vulnerabilities so we don't become our own worst enemies. The first two biases we need to watch out for are loss aversion and confirmation bias. Look at the scale. Loss aversion means the pain of a loss is felt twice as strongly as the pleasure of a gain. This leads to inaction, where investors hold on to losing stocks just to avoid realizing the loss. Then there is confirmation bias, also known as my side bias. This is like looking in a mirror that only shows you what you want to see. It is the tendency to prioritize information that confirms your existing beliefs while ignoring data that proves you wrong. Next, we have three more traps. First is ownership bias, also known as the endowment effect. Things we own appear more valuable to us simply because we own them. We might hold positions we would never buy at the current price. Middle is the gambler's fallacy. This is the mistake of predicting random events based on the past, like thinking a coin must land on heads because it landed on tails 5 times in a row. Finally, there is the winner's curse. This happens in competitive bidding. You might win the asset, but because you overpaid, you suffer a financial loss. The final set of biases involves how we interact with the crowd and the past. Herd mentality is when investors follow others due to uncertainty. As John Maynard Keynes said, it is often considered better to fail conventionally than to succeed unconventionally. This behavior leads to bubbles and crashes. Then we have anchoring. This is relying too heavily on the first piece of information, usually the price you paid, and ignoring new data. Lastly, there is projection bias. This is when we project the recent past into the distant future, assuming that what is happening now will continue forever while ignoring long-term history. To wrap up this video, we must consider how to communicate our findings. This brings us to the qualities of a good research report. Whether you are analyzing valuation, risk, or behavioral factors, the final deliverable must be clear. A good report should follow a checklist-based approach. The objective is to communicate value clearly and objectively, ensuring that the recipient can understand the risks and the potential rewards without ambiguity.